Welcome to today's Explainer. We're diving straight into an incredible analysis on mining giant Rio Tinto. For decades, this company has been basically defined by one thing, right? Its massive, dominant iron ore operations over in Western Australia. But if you look at the numbers coming out of the first half of 2026, that historical narrative is going through a massive fundamental shift. We are literally watching a company in the middle of a major transition.
So let's just dive right into the central mystery we're unpacking today. Rio's stock has been on an absolute tear, and on the surface, everything looks, well, perfect. But as we know in the mining sector, perfection is expensive. We're going to figure out if this stock actually offers genuine value right now, or if it's completely pricing in a Goldilocks scenario, where conditions are assumed to be just right, indefinitely, with absolutely zero room for error.
Here's our quick roadmap for today. We'll cover 1. A major structural shift. 2. The commodity price reality. 3. The valuation conundrum. 4. Dividends versus execution risks. 5. The bull versus bear case. And finally, 6. The final verdict. Let's get into it.
Starting with Part 1, a major structural shift.
The whole story around Rio Tinto is changing, and it's being driven by these massive global megatrends we talk about all the time, like AI and electrification. Check out this breakdown of their first half 2026 underlying earnings. For the very first time in Rio Tinto's history, copper and aluminium have actually overtaken iron ore. They now make up 56% of the company's underlying earnings. I mean, that's wild. This isn't just a brief cyclical blip. This is a permanent structural shift to supply the metals required for the future of tech and energy. The company is actively transforming right in front of us.
And honestly, that transformation has looked like a flawless victory lap. That structural shift helped push underlying earnings up a super impressive 43%, hitting a staggering $6.85 billion. Because of this huge windfall, the company rewarded shareholders with a $2.11 interim dividend, which, by the way, is their highest in 4 years. So at face value, Rio Tinto seems absolutely unstoppable right now.
But that brings us to Part 2, the commodity price reality.
The stock market is forward-looking, right? So to understand if Rio's record profits are actually sustainable, we have to take a really close look at the macro environment, because this is where the real risks are hiding. Right now, commodity prices are riding incredibly high. Copper is hovering near all-time highs of roughly $6.20 a pound, and aluminium is holding firm. But analyst reports point out that these prices are being artificially inflated. Geopolitical tensions, specifically the Iran war, are creating major supply disruption premiums. It's really crucial to understand that these prices are currently being propped up by global instability rather than just pure baseline demand.
And that perfectly illustrates the danger of extrapolating today's prices into the future. Just look at this visual contrast. On the left, we've got today's copper price at around $6.20. But on the right, look at the mid-cycle assumptions. Morningstar's long-term forecast for copper from 2030 onwards is just $3.80 a pound. That's nearly half of where we are today. Rio's earnings are deeply cyclical, so a reversion to the mean in commodity prices would compress their current margins in a huge way.
And the exact same warning applies to iron ore. Analysts at RBC Capital forecast iron ore prices dropping down to just $85 per ton by the end of 2027. The market right now seems to be kind of assuming today's sky-high prices will just last forever, and that sets up a massive danger of cyclical margin compression down the road.
Which leads to Part 3, the valuation conundrum. With record earnings and peaking commodity prices, the stock itself has surged nearly 100% over the past year. It's currently trading around $105, which is just shy of its 52-week high of $112. Now, this massive run-up has deeply divided Wall Street analysts, creating a pretty stark contrast in outlooks. On the left, you've got major players like Goldman Sachs and Argus upgrading the stock to buy and strong buy, heavily focusing on that positive growth outlook and the copper narrative. But on the right, you've got critical voices like RBC Capital, who've actually downgraded Rio to underperform, warning that the stock is severely overvalued. We're looking at this completely impartially, so let's dig into the math behind that skepticism.
Let's break down RBC's specific valuation math. Notice the EV to EBITDA multiple. This is basically a metric of how expensive the company is compared to its core cash earnings. Rio's currently trading at a 7.1 times multiple. Now, that might not sound astronomically high in isolation, but look at the column next to it. That is significantly above its 3-year historical average of just 5.2 times. Plus, the stock has broken above its 200-day moving average and is currently trading right at analyst average price target of roughly $105.50. What does this mean?
It tells us the market is paying a really heavy premium for execution that simply hasn't happened yet.
All right, part 4, dividends versus execution risks.
This sets up such a fascinating psychological trap for investors. How do you balance a highly attractive income stream against some very real operational dangers? Because despite all those valuation concerns we just looked at, the dividend is the lifeline keeping investors anchored to this stock. Rio offers a really compelling forward yield of roughly 4 to 4.4%. I mean, they have an incredible track record of paying dividends for 35 consecutive years, backed by a fortress balance sheet that generated $9.2 billion in cash flow in just the last half year. That income stream is, for sure, incredibly tempting.
But here's the catch. According to RBC, to justify its current price and actually sustain that payout, the market is pricing in 3 absolute ideal conditions. First, aluminum market conditions must remain perfectly supportive. Second, iron ore margins have to stay resilient despite those forecasted price drops we talked about. And third, Rio must execute its mega projects flawlessly. If commodity price is correct, and history pretty much guarantees they eventually do, that dividend yield isn't going to protect the share price from a nasty drop.
Let's zoom in on that execution risk for a second. Major growth drivers like the Simandou iron ore mine in Guinea, which is currently 77% complete by the way, and the Oyu Tolgoi copper mine are absolutely crucial to the story. RBC's warning is loud and clear here. The stock is trading as if these massive projects are already completely finished and delivering peak profits. There is literally zero margin of safety, and in the mining sector, a margin of safety is usually just a fancy phrase for a hard hat. Any delay, political hiccup, or cost overrun will immediately result in a negative repricing of the stock.
Okay, part 5, the bull versus bear case.
With all these pieces on the table, let's summarize the core conflict, because it's a perfectly balanced scale. On the bull side, the argument is that you're buying world-class, low-cost assets and a company successfully transitioning to future metals like copper and aluminum. You get paid a solid 4% yield just to sit and wait, and if copper stays high, the upside is massive. But on the bear side, the risks are glaring. You're buying a mining stock that's up 100% in a year, at absolute peak commodity prices artificially inflated by war premiums. You're assuming everything will go perfectly. And man, in the mining sector, assuming flawless execution is a very dangerous game.
Which brings us to our final part, the final verdict.
So where does all this leave us? Look, Rio Tinto is undoubtedly a world-class operator that can survive downturns, but investors are paid to manage risk, not just chase momentum. Because the stock is trading at a premium to its historical averages and sitting right at target prices, the analyst's explicit recommendation is this. If you're an existing holder, hold the stock, collect your dividend, but keep your stop losses super tight. But if you're looking to start a new position right now, the risk-reward is highly unfavorable. This is simply not the time to enter. The downside risk of a reversion to long-term averages is just way too steep.
So the crucial point here is knowing exactly when to act. The analysts recommend waiting for a pullback to the $90 to $95 range before you even consider taking an aggressive position. You really want to monitor iron ore prices and keep an eye on the completion of that Simandou mine for your entry triggers.
Which brings us to the core lesson of today's explainer, and a question I want to leave you with. When you see a stock that has basically doubled in a year, and you hear all these promises of a flawless transition into the future, as an investor, are you actually managing risk, or are you simply chasing momentum? Thanks so much for learning with me today, and keep questioning the data.